Right now, while you're sitting here watching this video, some of the biggest corporations on the planet are quietly building their future on a blockchain that most retail investors can't even spell correctly. Google, IBM, FedEx, McLaren Racing, Boeing, Deutsche Telekom. These aren't speculative partnerships. These companies actually govern the network. They run nodes. They vote on protocol upgrades. They have real skin in the game. And while they're doing all of that, HBAR is still sitting at under 10 cents. Still ignored, still written off, still dismissed by the crowd chasing meme coins and AI narrative tokens with zero fundamentals. So today we're going to answer the one question that actually matters here. Why are corporations all in on Hedera while retail is completely out, and what does that tell us about where this thing is headed? First, let's just look at the numbers and let them sit with you for a second. HBAR is currently trading around 9.5 to 9.7 cents. That's the price. That's what the market is saying this token is worth right now. And on the surface, if you're scrolling through CoinMarketCap, you might just pass right by it. It doesn't look exciting. There's no flashy chart. No 40% overnight pump because some influencer tweeted about it. But here's the thing. That same token sitting at roughly 10 cents is 83% below its all-time high of 0.569, which it hit back in September 2021. And in the years since that peak, while the price has been grinding sideways and slowly bleeding, the actual network underneath has been doing the exact opposite. The fundamentals have been compounding, the adoption has been accelerating, the institutional pipeline has been filling up, and the market just hasn't noticed yet. That gap between price and reality is exactly what we're talking about today. Because in crypto, these gaps don't last forever. And historically, when they close fast. Let me ask you something. When you hear the words governing council in the context of crypto, what do you picture? Most people think, okay, some random validators, a few anonymous whale wallets, maybe a couple of DeFi protocols. Standard stuff. Hedera's governing council is something completely different. As of April 2026, the Hedera Governing Council has 39 members. 39. And the names on that list would make any boardroom in New York or London take notice. We're talking about Google, IBM, Boeing, Deutsche Telekom, FedEx, and most recently McLaren Racing. These aren't companies that dabble in crypto for PR purposes. These are trillion-dollar enterprises that went through months of legal due diligence, compliance review, and governance evaluation before joining. And they keep joining. FedEx came on board in February 2026, specifically to support on-chain logistics verification. Think about what that means for a second. FedEx, one of the largest logistics companies on Earth, chose Hedera to put its supply chain on-chain. Not Ethereum, not Solana, not Avalanche, Hedera. There's a reason for that, and we'll get to it. Then, just last week, March 25th, 2026, McLaren Racing joined as a full governing member. Full voting rights equal to every other member on the council. The two-time reigning Formula One Constructors champions are now co-governing a blockchain. This isn't a PR stunt. They're in the room making protocol decisions alongside Google and IBM. The model is one member, one vote. No single entity controls the network. Term limits prevent entrenchment. It's designed to be stable, compliant, and enterprise-grade, exactly what these corporations need. This isn't DeFi Wild West. This is infrastructure that a Fortune 500 legal department can actually approve. When you look at that list and then look at the price, the disconnect is almost comical. Almost. Here's something else the retail crowd mostly missed. On October 29, 2025, Canary Capital listed the world's first spot HBAR ETF on Nasdaq. That's huge. That's a major milestone. Bitcoin ETF, everybody knows about it. Ethereum ETF covered wall to wall. HBAR ETF, crickets from most mainstream crypto media. And yet, by March 30th, 2026, That ETF had pulled in $93.21 million in cumulative inflows. $93 million from institutional investors buying HBAR through a regulated exchange-listed product. This isn't retail money. Retail doesn't use ETFs for altcoins. That's pension funds, family offices, hedge funds regulated capital finding its way into HBAR through the cleanest possible on-ramp. And it gets better. Right now, there are 15 additional HBAR ETF applications pending SEC review. 15. That pipeline could completely reshape how institutional money accesses the Hedera network. When those get approved and given the current regulatory climate, that's a when, not an if. You're looking at a massive expansion of institutional access. The walls of capital that couldn't touch HBAR before will suddenly have a clean, compliant, regulated door to walk through. HBAR became the first altcoin ETF outside Bitcoin and Ethereum to hit the 93 million milestone. And most retail crypto investors still don't know the ETF exists. That's the HBAR story in a nutshell. The institutions found it. Retail is still looking elsewhere. Let's talk about something that matters enormously in 2026 regulation. The SEC and CFTC have officially classified HBAR as a digital commodity, not a security. A commodity. That single classification changes everything for institutional adoption. It removes the legal overhang that has kept so many regulated entities away from crypto assets. When your compliance department can point to an official government classification that says, this is a commodity, not a security, the conversation at the board level changes completely. HBAR also aligns cleanly with the US Genius Act framework and the EU's MiCA regulations. Hedera's governance model with its AML and KYC compliant council structure and permission node operation was essentially built for this regulatory moment. While other blockchains are scrambling to retrofit compliance into protocols that were never designed for it, Hedera has been compliance forward from day one. This is a network that was built in a boardroom as much as it was built in a codebase. And in 2026, as regulatory clarity becomes the single most important factor for institutional adoption, that design philosophy is paying dividends. Now, let's talk about what Hedera actually does, because this is where the story gets really interesting. The Hedera network has now processed over $10 billion in real-world asset settlements. $10 billion. We're talking tokenized UK government bonds, tokenized real estate, tokenized commodities, actual financial instruments being settled on-chain through Hedera's infrastructure. Real-world asset tokenization, RWA, is the hottest institutional narrative in crypto right now. Every major bank, every asset manager, every fintech giant is racing to put traditional assets on-chain. BlackRock is doing it, JP Morgan is doing it, and when enterprise clients look at which blockchain to actually do it, on a significant portion of them are choosing Hedera. Why? 3 reasons. Speed, cost, and governance. Hedera processes transactions in under 3 seconds with absolute finality. Not probabilistic finality like proof-of-work chains, absolute. Once it's confirmed, it cannot be reversed. For financial settlements, that's non-negotiable. You can't have a $1 trillion treasury transaction sitting in a probably confirmed state. Transaction fees on Hedera are fractions of a cent consistently, not volatile gas fees that spike during network congestion. Fixed, predictable, enterprise-grade pricing. When you're processing thousands of financial transactions per day, that price stability matters more than any DeFi yield. And the governance, as we already discussed, gives enterprises the confidence they need. They know exactly who's running the network. They know the rules. They know their legal teams can work with this structure. The $10 billion in real-world asset settlements isn't a marketing number. It's on-chain. It's verifiable. It represents real capital from real institutions flowing through Hedera's infrastructure. And it's only the beginning. On March 27th, 2026, just days ago, Hedera launched something called Hedera Agent Lab. If you haven't heard of this yet, pay close attention, because this is one of the most important developments in Hedera's history. Hedera Agent Lab is a browser-based platform that lets developers build on-chain AI agents. No-code, low-code, or full-code workflows, whatever your skill level, you can build on it. It integrates with industry-standard AI frameworks like LangChain, connecting artificial intelligence directly to live blockchain operations. Think about what this means. The fastest-growing tech narrative of our time is AI agents, autonomous software that can execute tasks, manage capital, interact with protocols, and make decisions without human intervention. Hedera just built a platform that puts those AI agents directly on-chain, with the full speed, cost efficiency, and compliance infrastructure of the Hedera network behind them. NVIDIA and ServiceNow joined Hedera through the HEAT program, specifically for AI data provenance, the ability to create verified, tamper-proof records of how AI systems make decisions. In a world where regulators are increasingly demanding AI accountability and transparency, that's not just a nice feature. That's a legal requirement waiting to happen. The Hedera Agent Lab roadmap includes integration with Hedera Stablecoin Studio for DeFi operations, and a no-code controls panel for setting transaction limits and security policies. This is AI infrastructure built for institutions, not crypto-native degens, but actual enterprise clients who need auditable, compliant, verifiable AI systems. And here's the thing about AI agents and HBAR. Every single AI agent transaction that runs through Hedera's network requires HBAR to pay fees. The more AI activity on the network, the more demand for HBAR. The tokenomics of this narrative are clean. They make sense. And they're just getting started. If Hedera Agent Lab was the shot heard around the enterprise world, block nodes are the follow-up that retail hasn't even priced in yet. Hedera recently announced that block nodes will launch in June 2026, just 2 months away. Here's the simple version of what that means. Right now, Hedera's data infrastructure relies heavily on cloud storage solutions controlled by a relatively centralized set of providers. Block nodes replace that entirely with a decentralized data lake. It transforms Hedera from a fast, enterprise-grade blockchain into something closer to a full decentralized data infrastructure layer for the internet. Why does this matter? Because one of the main criticisms of Hedera from the crypto community, and it's a fair one, has been that it's too centralized. The governing council controls the nodes. It's a permissioned model. And while that's exactly what enterprises want, it gives hardcore crypto purists pause. Block nodes begin to change that narrative. It's a step toward a more decentralized architecture while maintaining the performance characteristics that make Hedera attractive to institutions. More decentralization means more credibility in the broader crypto ecosystem. More credibility means more attention. More attention means more capital. Block nodes in June 2026 could be a genuine catalyst event, a technical milestone that forces even the most skeptical critics to take a second look. Let's circle back to McLaren for a second, because this partnership is more interesting than it first appears. McLaren Racing didn't just join the governing council as a logo on a webpage. They launched MCL Collect, a free-to-claim digital collectibles program on Hedera, with drops timed to individual Formula One and IndyCar race weekends throughout the 2026 season. The first drop covered the Australian Grand Prix. The second coincided with the Chinese GP. The third is dropping this weekend for the Japanese GP. Completed sets enter holders into prize draws for McLaren Technology Center tours and signed merchandise. Crucially, and this is the genius of it, the collectibles are accessible through both native Hedera wallets and Web2, social sign-on wallets, meaning you don't need to know anything about crypto to claim them. You just need a social media account. Formula One has an estimated 600 million global viewers. McLaren is one of the sport's most beloved and iconic teams, and every single one of those fans who claims a McLaren digital collectible is being quietly onboarded to the Hedera network without even realizing it. Analysts called the McLaren deal the most significant brand awareness play in altcoin history. Whether you agree with that or not, there's no denying what it represents. the intersection of mass consumer sports entertainment and enterprise blockchain, built on HBAR. And mark your calendar, May 4th, 2026, McLaren's leadership is appearing at HederaCon in Miami Beach, scheduled alongside both the Formula One Miami Grand Prix and Consensus 2026. That event alone could generate more media coverage for HBAR than the past 6 months combined. So here's the question that drives everything. With all of this happening, the ETF, the governing council, the RWA settlements, the AI platform, the block nodes, the McLaren partnership, why is HBAR still under 10 cents? Why is retail completely ignoring all of this? There are a few answers, and they're all connected. First, HBAR doesn't trade like a retail crypto. It doesn't pump 20% because a meme went viral. It doesn't get featured in 1000x altcoin lists. Its narrative is fundamentals-based, enterprise-focused, and slow burn. Retail wants dopamine. HBAR doesn't do dopamine. Second, the market right now is in extreme fear. Bitcoin is below 66.0. The fear and greed index is sitting at 12. That's deep in extreme fear territory. When the market is panicking, retail sells. They go to cash. They chase stability. They do not sit down and do careful fundamental analysis on Layer 1 blockchain infrastructure tokens. Third, Hedera's governing council model is actually a turnoff for a large segment of crypto purists, not decentralized enough. The council has too much control. These arguments come up constantly on crypto Twitter, and while they have merit for certain use cases, they completely ignore the institutional adoption story. The same centralization that purists hate is exactly what Google's compliance department loves. But here's the thing about all of this. In markets, the best time to buy is almost always when everyone else is looking away. When the crowd is panicking, when the narrative is cold, when the chart is ugly, that's when the real accumulation happens. And the on-chain data confirms it. Chaikin money flow for HBAR recently climbed back above the neutral line after sitting in negative territory for months. Whale wallets have been quietly accumulating. The RSI was sitting at 33.8 deep in oversold territory, while institutional ETF inflows continued regardless. Smart money doesn't wait for retail validation. Smart money positions before the crowd shows up. Let's talk targets, because you want to know where the price is going. Right now, HBAR is trading around 9.5 to 9.7 cents, with key near-term resistance sitting at the 0.145 level last seen in December 2025. A clean break above that level would signal a new bullish phase and bring significantly more attention to the chart. Technical analysts are looking at a range of 0.38 to 0.5 as medium-term targets, aligned with ETF approval catalysts and ecosystem development milestones. For longer-term projections out to 2027 and 2028, some analysts are putting price targets above 0.5, with the more bullish scenarios dependent on mass RWA adoption and AI network growth reaching toward the 1 range. Let me put that in context. From current prices of roughly 0.1, a move to 0.5 represents a 5x. A move to 1 represents a 10x. These aren't fantasy numbers pulled from thin air. They're based on comparable, fully diluted market cap scenarios, given where Hedera's utility and adoption are heading. And remember, HBAR's all-time high was 0.569. Just getting back to that previous high, not a new eighth, just a return to a level this token already achieved once, would represent roughly a 6x from current prices. That's what recovery to ATH looks like. And it doesn't require any new adoption to justify it. The current adoption level already surpasses what the network looked like in 2021. Let me give you the 3-scenario framework for HBAR in 2026. Conservative scenario. The 15 pending ETF applications get slow. Walk through the SEC. The market stays in fear mode. HBAR drifts back up toward 0.14 to 0.18. As existing ETF inflows continue, and the McLaren partnership generates some organic retail attention. Quiet, steady, frustrating for impatient holders. Base case scenario: 2 or 3 of the pending ETF applications get approved in Q2 or Q3 2026. Block nodes launched successfully in June. AI agent activity on Hedera starts driving measurable fee revenue. HBAR breaks the 0.2 convincingly and tests the 0.3 to 0.4 range. The narrative starts reaching mainstream crypto media. Retail begins to discover the story. Bull case scenario: multiple ETF approvals, a broader crypto market recovery as Bitcoin reclaims momentum. Block nodes launch to strong developer adoption. The McLaren and Hedera event generates significant media coverage. And one or more major TradFi institutions announce a flagship RWA project on Hedera. In this scenario, the 0.5 ATH gets tested. We could be talking about a genuine 5x to 6x from current levels within 12 to 18 months. None of these scenarios require HBAR to become a meme. None require a celebrity endorsement. None require a bull market miracle. They're all based on fundamentals that are already in motion, pipelines that are already full, and catalysts that are already scheduled. Here's the bottom line, and I want you to really hear this. In 2026, you have a choice. You can chase the coins being screamed about on TikTok and Twitter, the ones that pop 50% in a week because some influencer pumped them to his audience. The ones with no governing council, no RWA infrastructure, no Fortune 500 partners, no ETF on Nasdaq. Or you can look at where the corporations are quietly building, where the institutional money is actually flowing, where the regulated financial infrastructure is actually being laid. Google chose Hedera, IBM chose Hedera, FedEx chose Hedera, McLaren Racing chose Hedera. The SEC classified it as a digital commodity. A 93 million ETF is live on Nasdaq. Over $10 billion in real-world assets have been settled on this network. And the token is sitting at 10 cents. That's the disconnect. That's the opportunity. And historically, in every market cycle, these disconnects between fundamental reality and market price don't last forever. The question isn't whether corporations are building on HBAR. They clearly are. The question is, will you be positioned before retail finally figures that out? That's it for today. If this video helped you see HBAR differently, drop a like, subscribe if you're new, and let me know in the comments. Are you holding HBAR or are you still on the sidelines? I read every single comment. I'll see you in the next one.